We'll continue this conversation around Nigeria's third quarter GDP, now fresh about an hour ago from National Bureau of Statistics. The headline, GDP was 1.81%. Let's bring you up to speed very quickly, 1.50% for the second quarter of the year. But we've talked a little bit about some of the sectors that gave us some of those growth. Cement manufacturing was a good one within the period. Under review, food beverages sector was up. Manufacturing sector jumps to 1.92%. Agri grew to 1.90%. But if you look at a few other sectors, things were not really that good. But before I left, the good news, rail transport. President Bakare and his administration are investing massively in rail transport. That sector grew 4.52%, a massive 4.52% from just 0.29% in second quarter. So I got the rail sector giving me positive numbers. Telecommunications was better, 4.97% from 11.54% in Q2. Publishing is also growing, 4.32% in third quarter. Motion pictures, sound recording, music production down a negative 0.45%, but slightly better than a contraction of 2.29% in second quarter. My industry, specifically broadcasting sector, grew just 4.01% in third quarter against 21.9% growth in the second quarter. I go to art and entertainment and recreation. The sector up 2.83% in third quarter, down from 3.48% in second quarter. Financial and insurance sector contracted nearly 5%, 4.81% in Q3 from 1.28% growth in second quarter and against 13.3% growth in the first quarter of this year. So the financial services sector is going down. Let's get this conversation going. Bismarck Rewane, the CEO at Financial Derivatives Company and Channels Television Economic Consultant. Where I held your thought, thank you very much, sir, for still being here, was the fact that power or electricity is very key to the entire conversation. But if you look at the non-oil sector GDP making growth and manufacturing, including cement, how did they achieve it? Generators?
No, there's alternative power, but generally speaking, electricity went up from 7.59 to 18.27. And you find that all those sectors that are constrained by electricity also perform better. In other words, manufacturing, ICT, telco, and others. Then, of course, cement manufacturers have their own power. Anybody who's in cement manufacturing has his own power station. So that's good. We've seen that happen. But the point I was trying to make was that because electricity generation improved in that quarter, you found that the constraints to productivity also was removed. Now, when we talk about productivity, without seeing the unemployment numbers, which have not been released for 18 months now running, we have not got unemployment data. I think they now say it's going to come out on the 24th of December, Christmas Eve. Then we can now begin to see whether how much of these sectors are actually employing people and creating, dealing with unemployment, because that's a key variable in the misery index. Unemployment plus inflation gives you the misery index. But having said that, when you look at the interest rate sensitive sectors, you find that those sectors are also suffering because credit to the private sector actually declined in the quarter. So you will now find that banking, financial institutions, and real estate, actually, even though it improved, but it's still declining by minus 2.68. Education, oil and gas. So all of the sectors that are interest rate sensitive, credit, quantum sensitive, have also suffered. So when we try to decompose these numbers, we must begin to understand, one, how much of it is dependent on credit, how much of it is dependent on new investment, which was lacking, how much of it is dependent on government investment multiplier. So these are the things that we have to deal with to make sure that we can get into our growth. Remember that South Africa came out of their recession in one quarter. It took us 6 quarters to get out of recession, which shows that our economy does not have the versatility, right, and the robustness which the South African economy had in recovering, bouncing back from a recession into positive growth within 1 quarter. It took us 6 quarters to bounce back.
Mr. Rewane, thank you so much. But let's get a bit more of this breakdown, sectorally speaking, when we look at the latest economic report. So let's go live to our Abuja studios where Uwaleke, professor of capital markets and economist, is also standing by. If you look at this breakdown sector by sector, rail sector, and I don't want us to mix this up, miss this particular sector within the conversation. Rail transport and pipelines under transportation and storage grew a massive 4.52% in third quarter against a paltry 0.29% in second quarter. Do you think the Buhari's railways are coming in here?
Yes, I think it has to do with the fact that from the beginning of the third quarter, we began to see the gradual implementation of the 2018 budget. Part of why we had that major slump in GDP numbers in Q2 of 2018 was because the budget was not yet out and implementation, hadn't started. Yes, of course, you know that the government spending, even though it represents just about 10% of aggregate demand, it's actually what drives, the rest of, the economy. So the fact that we had the budget, implemented, to a certain degree, particularly the capital component, could explain why we are having a positive, growth rates in the transport sector, particularly, of course, the concessioning arrangement that is still going there, and road and water transport. But let me also say this, that part of why we also had this marginal improvement also has to do with the stability we have noticed, especially during that quarter, in the exchange rate. And some interventions too by the Central Bank of Nigeria, particularly in the area of agriculture and manufacturing, trying to target credit to the real sector. Recall that it was after the MPC meeting of July that the Central Bank decided to come up with this differentiated real cash reserve ratio that was meant to give credit to the real sector at a single digit. Yeah, the impact of that, may still be unfolding, but one could also tie what has happened to some of the policies, that have been put in place over time. But what's important to say here is that the growth could have been more. Recall that the IMF is projecting that the economy will be growing at 1.9% for 2018. And if we don't do something higher than that in the last quarter of 2018, it means that we may not be getting to 1.9, even though the CBN forecast for 2018 remains 1.75. But as I said earlier on, the growth could have been more if, for example, the implementation of the capital component of 2018 budget, is a lot more ramped up, a lot more, giving a vent than what it is at the moment. Of course, we know it also has to do with the issue of, revenues. And it was not until recently that the federal government was able to, get $2.7 billion that it intends to put into infrastructure projects. So if we have recorded marginal improvements in manufacturing, for example, in agriculture, as I said, this you could tie to, the fact that the budget is now being implemented, unlike the situation in Q2 of 2018. But we could have had better improvements. Let's
move on this conversation.
Farmers' herdsmen clashes.
Professor Uwaleke, let's move on this conversation. Thank you very much for weighing in. Let's get into the financial services sector. Let's talk to Bakare, who is the macroeconomist strategist for AfriInvest in our studios at the Nigerian Stock Exchange. This is what the financial and insurance sector contracted nearly 5% in third quarter from a positive 1.28% in second quarter and down from 13.30% in the Q1. Then you find financial institutions under financial and insurance sector contracting a massive 5.67% from a positive 0.81% in second quarter and a positive 12.58% in Q1. This is your sector, isn't it? This is your sector contracting massively.
Yes, absolutely. The performance in financial services is still very, very disappointing. From what we saw in Q1, where there was a much stronger growth in Q2 and Q3 2018 GDP numbers, we've seen even a contraction in Q3 GDP, and we believe it's still in line with recent trends we've seen in the financial services sector of the economy. Over what we've seen for most of 2018 is that, for instance, banks have been very, very cautious about lending. So you've not seen a lot of banks have instead, channeled their assets into investments in government securities rather than investing in the real economy through credit. So we've seen a general contraction in credit, and going by the performance of banks in Q3 2018, the earnings releases we saw, if you remove a few tier 1 banks who are outperforming, you see that the rest are not doing quite as well. So in insurance, the trend is similar. It's just basically showing that we need a better rejig of structural barriers to the growth of both sectors. So looking at the ease of doing business in the economy, the sectors that should get credit, agriculture, for instance, that is over 20% of GDP and getting less than 5% of credit. We need to look at ways to how to make the sector more bankable to bank credit, because in the end, banks are looking for profit, and if there's no guarantee that they're going to recoup all the loans they give to particular sectors, then they won't lend. Also in insurance, you see that the insurance penetration is still very, very weak, and that shows that there's a lot of improvement needed in the sector in terms of both the life and non-life segment and other subsectors of the insurance sector. In the insurance sector, basically, we need reforms, we need consolidation as well to drive the capacity of insurance companies to take more risks and to play a bigger role in the real economy. So basically, what we're seeing in financial services sector is still reflective of the structural barriers, the challenges that is prevalent in the overall real economy so far.
This is Rewane at our financial derivatives company. This is your financial services industry thinking. Give us your take.
No, two things are happening at the same time. One is that the compliance with IFRS 9 means that the banks are having to provide, to write off a lot of poor credits. Secondly, the CRR, strong implementation of CRR means that the liquidity of the banks is being squeezed. And thirdly, and most importantly, is that the return on government securities, which the banks got in 2017, which was as high as 18-19% for 365-day paper, they are getting only 14-15%. So compression of interest revenue because of lower yields on government securities, tightness in liquidity because of over enforcement of the CRR, and more than anything else, now the IFRS 9 which means that impairment rates have increased and banks are having to make greater provisioning. So all of these things put together have actually dampened the enthusiasm of the banks to extend additional credit, and while they're also watching their cross-border currency exposures.
Okay, Mr. Rewane, when we come back after the break, we'll get all of you to talk about some other sectors that were underwater during this third quarter, and these are sectors where we find quite a number of Nigerians doing business in the arts and entertainment, music production, broadcasting, real estate in negative territory. All of this we'll put together when we come back after the break. This is the morning we're putting some flesh on those GDP numbers out of the statistics office. Headline figure, 1.81%, slightly below some forecasts of 1.9%, but much better than 1.5% in the second quarter of the year. The nominal GDP is came in at north of 33 trillion local currency. All this conversation will continue after the break. Beyond the GDP numbers, how do we fix the economy as we go into the election year? My panelists will talk about that when we return in 2 minutes. We'll be right back.